Silver is falling fast, but something bigger is coming. Silver just dropped, fast, hard, and most investors are panicking right now. But here's what nobody is telling you. This drop might be the most important buying signal of the decade. Stay with me, because what's happening beneath the surface of the silver market right now has nothing to do with what you're seeing in the headlines. And by the end of this video, you're going to understand something that most retail investors won't figure out until it's already too late. Let me ask you something. When you see silver falling, what's your first instinct? Sell? Wait? Panic? That's exactly what the smart money wants you to do. Because while you're watching the price go down on your screen, something much bigger is being quietly set in motion. Something that doesn't show up on a price chart. Something that takes months, sometimes years, to fully reveal itself. We're going to talk about what's really driving silver right now. We're going to talk about the Federal Reserve, about industrial demand, about a supply deficit that the mainstream financial media is almost completely ignoring. And we're going to talk about why the very thing that looks like a crash right now might actually be the setup for one of the most explosive silver moves in modern history. But first, you need to understand why silver falls, and why that's not always what it seems. Silver is a strange asset. It's not quite a currency. It's not quite an industrial metal. It lives in this uncomfortable middle ground, and that's exactly why it gets hit hard when uncertainty spikes. When fear enters the market, investors don't think, they react. And the first thing they do is sell anything that isn't cash. That's what you're seeing right now. But here's what the panic crowd isn't stopping to ask. Why is the dollar strong right now? Why are yields elevated? Why is risk being repriced across the board? Because the Federal Reserve is still playing a very dangerous game. After years of easy money, after pumping trillions of dollars into the financial system, the Fed is now trying to convince markets that it's serious about inflation, that it's disciplined, that it's in control. But the numbers tell a different story. US debt just crossed $36 trillion. The interest payments alone on that debt are now running at over $1 trillion per year. Let that sink in. The United States is spending more on interest payments than it spends on defense. That is not the picture of a system that's under control. That is the picture of a system that is slowly, quietly being cornered. And silver, real physical silver, has historically been one of the first assets to signal when that corner gets tight. Now let's talk about something almost nobody in mainstream finance is covering. Silver has been in a structural supply deficit for 4 consecutive years. That means the world is consuming more silver than it is mining. Every single year. Think about that for a moment. We're not talking about a temporary imbalance. We're not talking about a seasonal dip in production. We're talking about a sustained, multi-year gap between supply and demand. And it's getting wider, not narrower. Why? Because the demand side of the silver equation has transformed completely over the last decade. Silver used to be mostly about jewelry, silverware, photography, old world industrial applications. That world is gone. Today, silver is a critical component in solar panels. It's inside every electric vehicle. It's embedded in the AI infrastructure boom, in the semiconductors, the circuit boards, the advanced electronics that are being manufactured at a pace the world has never seen before. The green energy transition alone is projected to consume hundreds of millions of additional ounces of silver per year over the next decade. And here's the brutal reality. You can't just turn on a silver mine overnight. It takes 10 to 15 years to discover, permit, develop, and bring a major silver mine into production. The pipeline of new supply is thin, and the demand curve is going straight up. When supply is falling and demand is rising, historically, mathematically, inevitably, price follows. The only question is when. And that question brings us to the most important part of this story. Let's talk about the Federal Reserve. Because right now, the Fed is the single biggest force pressing down on silver prices. And understanding what the Fed is trapped in right now is the key to understanding where silver is going next. Here's the situation in plain language. The Fed raised interest rates aggressively to fight inflation. That made the dollar stronger. And when the dollar gets stronger, commodities priced in dollars, including silver, tend to fall in price. That's the mechanical reason silver is under pressure. But here's what the Fed knows and won't say out loud. It cannot keep rates high forever. At $36 trillion in debt, every percentage point of interest rate costs the US government hundreds of billions of dollars per year. The math is brutal, and it compounds. At some point, and that point may be closer than most people think, the Fed will have no choice but to pivot. Not because inflation is defeated, but because the system can't afford the cure. And the moment the market smells that pivot coming, silver doesn't just recover, silver explodes. We've seen this before. In 2008, after the financial crisis, silver went from around $9 per ounce to nearly $50 in less than 3 years. Not because the world suddenly discovered silver, but because the Fed flooded the system with liquidity, the dollar weakened, and real assets repriced violently upward. The conditions building right now are, in several important ways, more extreme than 2008. More debt, more deficit spending, more geopolitical fragmentation, and a silver market that is fundamentally tighter than it has ever been. If these conditions continue to develop the way the data suggests, the historical pattern points toward a repricing that most retail investors will completely miss because they sold during the dip. De-dollarization and the geopolitical layer. There's another layer to this story, and it's one that mainstream financial media almost never connects to silver. De-dollarization. For 80 years, the US dollar has been the world's reserve currency, the anchor of global trade, the standard that every nation holds in its central bank vaults. That era is not ending tomorrow, but it is being slowly, deliberately eroded. China, Russia, India, Brazil, and over 40 other nations are actively building trade systems that bypass the dollar. BRICS is no longer just an acronym, it's a geopolitical project designed to create a parallel financial architecture. And when the dollar loses reserve status, even partially, the consequences for commodity prices are enormous. Because right now, oil, gold, silver, copper, all priced in dollars. The dollar's strength artificially suppresses these prices for international buyers. The moment that suppression weakens, the real price discovery begins. Central banks have already been signaling this shift. They've been buying gold at the fastest pace in 50 years. And where gold leads historically, silver eventually follows, often with more velocity. Because silver's market is a fraction of the size of gold's, even a moderate flow of capital into silver can move the price dramatically. Smart money isn't waiting for the headlines to confirm this. Smart money is positioning now, while retail investors are watching the price fall and assuming it's broken. Section 5. The gold-silver ratio. Here's a number I want you to remember. 80. That's roughly where the gold-silver ratio sits right now. The gold-silver ratio tells you how many ounces of silver it takes to buy 1 ounce of gold. Right now, that number is historically elevated, meaning silver is cheap relative to gold. Historically, when this ratio climbs above 80, it has almost always corrected. And when it corrects, silver doesn't just catch up to gold, it outperforms gold dramatically on the way down. In 2011, the ratio collapsed from over 80 to below 35 in just a few months. In 2020, it went from nearly 125 down to 65 in less than a year. Both of those moves produced life-changing returns for silver investors who positioned early. We are currently sitting in the zone where, historically, the setup begins. That doesn't mean tomorrow. It doesn't mean next week. Markets are not machines. They don't follow calendars. But if you understand what this ratio has meant across a century of market history, you understand that sitting here, at this number, silver is not a risk asset that's breaking down. Silver is a coiled spring. Section 6. What smart investors are doing right now. So what do you actually do with this information? First, understand what this dip is. A dip driven by dollar strength, by Fed policy, by short-term sentiment. Not by a change in the fundamental supply-demand story. Not by a collapse in industrial demand. Not by some structural flaw in silver's long-term case. The fundamentals haven't changed. The price has changed. Those are two very different things. Second, understand the asymmetry. If the Fed pivots, and history suggests it will, because the debt math leaves no other option, silver has massive upside from current levels. If it takes longer than expected, you're holding an asset with real industrial utility, real supply constraints, and real monetary heritage. The downside is time. The upside is magnitude. Third, think like an institution, not like a retail investor. Institutions don't buy tops. They accumulate during periods of uncertainty and weakness. They buy when sentiment is poor and prices are falling. And then they wait months, sometimes years, because they understand that the money isn't made in the move, it's made in the positioning before the move. The retail investor panics at a falling price chart. The informed investor reads the chart differently. They see opportunity dressed up as fear. Which one are you going to be? Let's talk about catalysts. Because silver doesn't move in a vacuum, it moves when triggers occur. What are the triggers to watch? The first is a Fed pivot signal. Any serious language shift from the Federal Reserve, any hint that rate cuts are coming sooner than expected, could be the match that lights this. Watch the FOMC statements. Watch the dot plot. Watch what the Fed says about the labor market and financial stability. The language will shift before the policy does. The second is a dollar breakdown. The dollar index has been propped up by rate differentials, the fact that US rates are higher than much of the rest of the world, drawing capital toward dollar assets. If those differentials narrow, the dollar falls, and silver moves inversely to the dollar. The third is a credit event, a major bank, a sovereign debt crisis, a corporate bond blow-up. Any significant credit shock could force the Fed's hand much faster than anyone expects. History is full of moments where the Fed planned to hold rates high, and then something broke, and they had no choice but to cut. The fourth is the physical market. If industrial demand continues to outpace supply, and the data strongly suggests it will, we could see physical shortages that force a repricing completely independent of paper market dynamics. That would be a silver move unlike anything we've seen in decades. You don't need all four. You don't even need two. One of these catalysts is enough to change everything. Let me leave you with this. The history of silver is not a history of smooth, comfortable gains. It's a history of long, painful consolidations, followed by violent, explosive moves that leave most people behind. The people who make money in silver are not the ones watching the price every day. They're not the ones panicking at every dip or celebrating every spike. They're the ones who did the work, who understood the fundamentals, who had the patience to hold through exactly the kind of moment we're in right now. Right now, silver is falling. The headlines are negative, the sentiment is poor, and most retail investors are either selling or staying away. That is precisely the environment in which the next major silver move is built. The question isn't whether silver will recover, given the supply deficit, the debt dynamics, the Fed's structural trap, and the industrial demand revolution. The historical math is not subtle. The question is whether you will be positioned when it does, because the window doesn't stay open forever, and by the time the mainstream catches on, the move will already be halfway over. Think about that, and I'll see you in the next one.